I am Dr. MWENDA MAKATHIMO, and I will be teaching you Introduction to Real Estate Valuation. And today we will cover the general concepts and principles in valuation. We will cover them with respect to generally accepted valuation concepts and principles that have been set by the IVSC, International Valuation Council, that sets the standards by which valuers operate under globally, and these are the standards that we will embrace, or that all valuers embrace, because they guide the practice of valuation globally. And the concepts that you need to understand includes what land and property means. So we'll start with the land and property concepts. And generally, land is of course essential to our lives and our existence, and it is important because it brings to consideration by lawyers, geographers, real estate economists, and all these disciplines look at land differently. Now it is used by society and the world, but the valuation of land, whether vacant or developed or with improvements, is basically an economic concept. Whether vacant or improved, land is also referred to as real estate, and the value is created by real estate's utility, or the satisfaction of the needs of human beings. So it is the utility that creates value in land, whether vacant or improved, or the capacity to satisfy needs of or wants of human beings and societies. And what the value that real estate contributes is because of its durability and it's being fixed in a location, and that of course real estate being of fixed supply and having very, very specific utility to a certain site gives it that characteristic of having special or specific utility. Then that becomes a question of determination. All right? Property is generally a legal concept, and comprises all interests, rights, and benefits that are related to ownership, or even access or use. And they contain rights of ownership, either entitled to a specific owner, or interests. That interests are what is owned. And to distinguish between real estate, which is a physical entity, and its ownership, which is a legal concept, the ownership of real estate is called real property. So real estate is the physical. Real property is the ownership interest. And the combination of the rights associated with ownership of real property in some states is referred to as the bundle of rights. So the real property is that bundle, the bundle of rights that you have over a certain property or over a certain real estate. Yeah? So bundle of rights over real estate is what is called real property. And concepts like property ownership are equated to a bundle of sticks, where each stick represents a right. For instance, if you own property, one, and you have a bundle, like the bundle of sticks, or those who visualize firewood, the way firewood is tied into a bundle, you can remove one piece of firewood each at a time. So if you put it into context, you would say then the bundle of rights of real property rights that are over real estate could be like the right to use, the right to sell, the right to pass through or access, the right to lease, the right to give away or dispose, the right to transmit, whether in inheritance or other rights or the right to develop. So these are the bundles that we are talking about. One may even have the right for occupation, yeah, over certain real property or real estate. So that bundle, the real property, is the bundle of rights over real estate. And real estate, we said, is land over land. Ownership of an interest in terms other than real estate is referred to as personal property. So if you own other properties that are not real estate, it's called personal property. And the one property, without further qualification or identification, may refer to real property, personal property, other types of property such as businesses, financial interests, or a combination. So property could be large. Property could have real property or personal property, and you have to distinguish. So when we talk about real estate, we are talking about real property. But you could have other properties that we call personal property, or even chattels or interests. Even shares could be properties that are not necessarily, they could be in financial terms or in business terms, that are not necessarily real. They are not over property. So property valuers, at times called asset valuers, in other jurisdictions like in America called appraisers, are the people who deal with this special discipline of economics associated with preparing and reporting valuation. As professional valuers must meet the rigorous tests of education, training, competence, and display skills that they must exhibit and maintain a code of conduct and standards of professional practice and follow the generally accepted valuation principles. So price changes over time result from specific general effects of economic and social forces. And general forces may cause changes in price levels and in relative purchasing power of money operating on their own momentum. Specific forces such as technological change and others may generate shifts in supply and demand of property that can create significant changes. So therefore, these changes are the ones that necessitate the valuation, because if there are changes, then the determination of value at a certain point becomes important. Many recognized principles are applied in valuation of real estate, and they include the principle of supply and demand, principle of competition, the principle of substitution, anticipation, expectation of change, and others. And common to all these principles is a direct or indirect influence on the degree of utility and productivity of a certain property. So consequently, it may be stated that the utility of real estate reflects the combined influence of all market forces that comes to bear upon the value of property. Then this brings us to the discussion of the concept of real estate, property, and the asset concepts. Again, just to clarify or amplify what we have mentioned, real estate is defined as the physical land and those human-made items which attach to the land. So real estate is the physical, land and the immovable attachments to that land. The physical is a tangible thing which can be seen and touched, together with all additions on, below, or above the ground. So real estate would comprise that physical and what is attached on, below it, or above it. And although these concepts discuss the physical, one has to appreciate that that physical goes to the core of the earth and to the skies. So what is attached could be above the ground to the skies, or could be on the surface, or could go all the way to the core. But just to remember is that real estate is tangible. Now, real property on the other hand, includes the rights, the interests, and the benefits related to ownership of real estate. The rights, interests, benefits related to ownership of real estate. And interests in real property is normally demonstrated by evidence of ownership or title deed, separated from the physical real estate. Real property is a non-physical concept. So let's pause and distinguish the two. Real estate is physical and tangible. Includes the land, what is affixed on it, below it, and above it, physical. A real property is non-physical. It is the bundle of rights, interests, and benefits that are associated with that physical real estate. And you have to demonstrate them by document, by proving that you have those rights, and it is defined by law. A legal instrument is what you use to demonstrate what you own in terms of real property. But the real estate itself, in its nature, is the physical, and it has physical boundaries. On the other hand, personal property includes interest in tangible and intangible items which are not real estate. So personal property is all other property that is not real property. And in terms of tangible personal property, of course, it's not fixed permanently. So it is not fixed permanently, and the general characteristic of personal property is that it is immovable. A car is personal property, it is immovable. A cell phone, it is personal property, it is immovable. Clothes, personal property, they are immovable. Shoes, I mean, a computer is immovable. But it's those immovable that are regarded as personal property, separate from real property and separate from real estate. Now, the other term that is important that we need to discuss is what is regarded to as depreciation, because it is used in valuation and it is used in accounting. And in valuation, sometimes you can use it in accounting or in valuation. It can create confusion. So to avoid that misunderstanding, a valuer may use the term depreciation or the term accrued depreciation. In terms of reproduction or replacement costs, one may refer to it as loss of value from the estimate of total cost of a new asset. Such losses are categorized and they are attributed either to physical deterioration, functional or technical obsolescence, economic obsolescence, or even technological obsolescence. And the term accruals for depreciation denotes allowance made by accountants to offset to the original cost of assets that deterioration in terms of costs. The other key concepts that we need to understand as an introduction before we get into the mechanics and the methods of valuation is what is costs, what is price, what is market, and what is value. So there could be some misunderstandings or misinterpretations because of how these terms are normally used casually within community and within a normal undertaking. So therefore it is important that in the discipline of valuation, the clarity of these concepts is attained and is made properly. Therefore, the concept of price refers to a term for the amount asked, offered, or paid for a good or a service. So price is amount asked, offered, or paid for good or service. So sale price is a historical cost, is a historical fact where it is publicly disclosed or kept confidential. because of financial capability, motivations, or special interests of a given buyer and seller, the price paid for goods or service may or may not have any relationship to the value which might be ascribed to the goods or services by others. Price is, however, generally an indication of a relative value placed upon a good or services by the particular buyer or seller under particular circumstances. So price is what is offered, what it asks, or what is paid for a good or service. Cost, on the other hand, is the price paid for goods or services. So price could be asked, offered, or paid. But cost is what is paid for goods or services. So cost is attributed to a payment having been made already. Or the amount required to create or produce a good or a service. So one can say it will cost me this to make this house, or it will cost me to provide you this valuation service. Or it could be it costed me, that means I paid this price. All right? When that good or service has been completed, its cost is a historical fact. The price paid for a good or service becomes its cost to the buyer. So when the buyer is saying it cost me, it means he already paid. He or she already paid. The one producing saying it will cost me, it means they are producing. They will incur that cost. A market, then what is a market? A market is the environment in which goods and services trade between buyers, sellers through price mechanism. So it means for that to be a market, there is buying and selling, and there is a price mechanism. That environment is what is referred to as a market. And the concept of a market implies that goods and services may be traded among buyers, sellers, without undue restriction on their activities. Each party will respond to the demand and supply relationships and the price-setting factors, as well as the party's own capabilities of knowledge, understanding, and relative utility to be derived from the goods or services, and the individual needs and desires. So a market can be local, regional, or national, or even international. So then what is value? Value is an economic concept to the price, referring to the price most likely to be concluded. All right? An economic concept referring to the price most likely to be concluded by the buyers and sellers of goods and services that is available for purchase. So value is not historical. It is the price that is most likely to be concluded, that is most likely to be attained. And value is not a fact, but an estimate. Remember, price is a fact, cost could be a fact, but value is an estimate of likely price to be paid for goods or services in accordance to a particular definition. The economic concept of value reflects a market's view of the benefits that accrue to one who owns the goods or receives the service as of the effective date of valuation. So it is trying to get the concept of the benefit that the buyer will attain. So there are many types of definitions of value, and we will see these definitions as we move on, because there are different types of value that one has to interpret, or you can advise based on the purposes. So who are valuers? Valuers are those people who possess the skills and the knowledge. So professional valuers possess knowledge of property, they understand the interaction between participants in the market, and therefore use that understanding and knowledge to judge the most likely prices. So that will be concluded between buyers in the case of a market. And market value then becomes what the valuers have determined to be most likely price that will be agreed between buyers in a certain market where there is no coercion, where there is knowledge, and where there is undue influence. The value concept contemplates a monetary sum associated with a transaction. It means there has to be money. So that sum we'll be establishing is about money. However, the sale of a property valued is not a condition requisite to estimating the price for which the property should sell if it was sold on the date of the property. Should sell if it was sold on the date of the valuation under conditions prescribed in the definition. Market value of real estate is a representation of its market's recognized utility rather than its purely physical status. So market value is a reflection of the recognized utility rather than the physical status of a property. The total cost of a property includes all indirect costs and direct costs of its production. So if you're talking about costs of a property, you have to look at the direct and indirect costs of its production. And if supplemental capital costs are incurred in the purchase, subsequent to the acquisition, they will be added to the historical acquisition cost. For cost accounting purposes, depending upon the utility of such costs, it is perceived by the market, they may or may not be fully reflected in property value. So costs may or may not be fully reflected in property value. A cost estimate for a property may be based on either an estimate of reproduction cost or replacement cost. Reproduction cost, therefore, is a cost to create a virtual replica of the existing structure, employing the same design with similar building materials. A replacement cost estimates the constructing a structure of comparable utility. So when we are talking of reproduction, it means you're doing a replica. You're reproducing the same utility, same physical design, everything. But replacement means you're focusing on utility, something that is an equivalent that gives same satisfaction. Then what is a market value? The concept of market value reflects the collective perceptions and actions of market and is the basis for valuing most resources in market-based economies. Although the precise definitions may vary, the market value concept is commonly understood and applied. Market value has been defined as the estimated amount for which property should exchange on the date of valuation between a willing buyer and a willing seller in an arm's length transaction after proper marketing, wherein the parties had each acted knowledgeably, prudently, and without compulsion. Remember, market value is defined as the estimated amount for which a property should exchange on the date of valuation between a willing buyer and a willing seller in an arm's length transaction after proper marketing, wherein parties had each acted knowledgeably, prudently, and without compulsion. That is key. All those considerations are key to understanding what is market value. So, it's important to stress that a professionally derived market value estimate is an objective valuation of identified ownership rights. You value the rights at a certain date. So, market value is a market-supported estimate developed in accordance to valuation standards. Real property is distinguished from most goods and services because of its relatively longer period required to market it. So it's an illiquid commodity. The characteristics of real estate make it a bit not easy to be converted to cash, and therefore it's important that that aspect is considered. The other principle that I wish we discuss is the principle of highest and best use. This principle is very, very key in the valuation exercise. Land is regarded as a permanent asset, but improvements upon to land have a life, they have a finite life. Because of their immobility of land, each real estate parcel possesses unique location. Land's permanence also means that it will normally be expected to outlast uses and improvements, which have a definite life. So this is a characteristic of land or real property, of real estate, a characteristic of real estate that is unique. Its permanency and the impermanency of the developments. So the unique characteristics of land then determine the utility of land. And therefore, it is important to get what is optimal utility of land. So most properties are valued both in terms of the land itself and the improvements. So the valuation is both a combination of the land and the improvements thereon. When properties are valued as a combination, then the value is higher rather than when land is valued separately and improvements are valued separately. So therefore, one would ask, then what is the highest and best use of a property so that the combined value of that improvements for that use and the land is optimal, is at its highest? That becomes a question. And therefore, the need to define what is the highest and best use of land. It is therefore defined as the most probable use of property, which is physically possible, appropriately justified, legally permissible, financially feasible, and physically possible, which results in the highest value of the property being valued. So it has to be financially, physically possible, justified, legally permissible, and financially feasible. So the key things: physical possibility, justification, legal permissibility, and financial feasibility. It means, and that use satisfying those three characteristics, then producing the highest value. That becomes the highest and best use of property. So it could be a use that could give you very high financial returns, but it's not legally permitted. So it's not legally feasible. What it means then that it's not the highest and best use. You could be building, say, a rental property in an industrial area and it is not allowed. It is giving you a lot of money, but it is an illegality. So when the law comes, you'll be required to demolish it. It means also you can have a use that is very good, but it is not physically possible. For instance, you have a marshy piece of land and you can build 10 stories or whatever with good returns, but then when you go to that land, that construction is not possible. So it becomes physically impossible. So as you analyze the highest and best use as a valuer, you have to put those considerations into place. And that the permission, the permits that you need to get are to do with the planning permissions. So it has to conform to the legal parameters for development control. This is where planning permissions are, either by public health authorities, by planning authorities, by county governments, by national governments. You could have a property that you can develop that is so nice, but is not permitted at a certain point. You cannot be allowed to build it in a forest because the area is zoned for forestry. You cannot be allowed to build it in a national park. The area is allowed for conservancy. So the law limits that. Physical possibility, I said, relates to the ground physical characteristics. And then because of market volatility and all that, there has to be financial feasibility. That's why feasibility studies are done to ensure that the highest incomes are attained within those other parameters. So the concept of highest and best use is a fundamental and integral part of market valuations or market value estimates. The other concept that is key that we need to discuss is the concept of utility. So the criterion for valuation in most real property or even personal property is the utility, the satisfaction that you will derive, and the procedure employed in valuation process have a common objective, that is defining and quantifying the degree of satisfaction, the degree of utility or usefulness of the property being valued. And this process of interpretation of utility concept is what really informs how valuation is carried out. So utility then from economics is a relative concept rather than absolute one, and therefore for instance, the utility of an agricultural land ordinarily measured by its productive capacity. Its value is function to the quantity and quality of produce, which can yield in agricultural sense, high quantity, high quality, depending on what is put there. So productivity measures the satisfaction, either commercially or others. So the satisfaction levels that a certain property derives in commercial terms, in real terms, is what is looked at. And I said it's not absolute, it's a relative term. Fundamentally, property valuations is governed by the way specific property is used or how it is ordinarily to be traded in the market. For some property, optimum utility is achieved if the property in question is operated by on an individual basis. Others, property has greater utility if operated as part of a group of properties. Properties owned and managed by a business enterprise such as a chain or a multiple retail outlets, food restaurants or hotels, therefore get optimal value or optimal utility because they are operated as a chain, because they have that distinction. And therefore the valuer will have to look at the views of how utility is maximized, whether individually or being operated corporately, for one to be able to determine the value of that property effectively. Some properties could be freestanding, and they could be self-contained, independent operations, and they are valued as such. Others may possess greater value or lesser value depending on the functionality or how they associate with other economic activities or other properties. So the interpretation of that association, because there could be what we call complementarity, or there could be economies of scale or diseconomies of scale, that has to be interpreted properly, and each property will have unique utility functions that then inform the value functions. A property could have possessed additional or special value above its value separate from the entity for reason of its location or for its functional association to adjoined property or others, and this could bring attractiveness to the buyer, and therefore beyond that utility that is seen from similar properties could have higher utility, therefore higher value. Utility is measured as a long-term perspective, ordinarily over the normal useful life of a particular property. Similarly, a property may not be readily discernible, may not have a readily discernible degree of utility at the date of the valuation because of external economic factors. For instance, if a property is situated in remote areas or in states that are experiencing volatile economic markets, its utility may not be discernible immediately. So therefore, the circumstances around where the valuation is being carried out are very, very important. So there is common effects of political economic uncertainty on the utility of property, whether in terms of capacity or efficiency. And therefore, it is the valuer's responsibility in such circumstances to ascertain, to assess the expectancy of the time span for such events, either temporary shutdowns, closures, that will have impact on the utility of the property, so that then those ones are taken into account while evaluation is being conducted. So these concepts and the interpretation of these concepts to determine the likely estimates of utility or the exchange of property at one point is what then would entail the valuation process. But it must be understood that We have discussed only concepts relating to market value. There are other concepts relating to value different from market value. For instance, statutory valuations or other valuations of special purposes. And it will depend on the need or the purpose for valuation to know what process then is followed. But the utilities and the interpretation of the utilities of a particular property is a key principle. There are other concepts that will influence value, but that will be subject for another lesson for another day. So thank you very much, and I hope that the concepts have been understood with clarity. Thank you.
These televised lectures supplement our robust online learning going on our MKU online platform. You can view more on our televised lectures via our online platform. We are in a digital era, and Mount Kenya University knows this. The following are the steps to follow so as to complete your online application. Download the application form from the website www.mku.ac.ke. Attach copies of your academic certificates and ID. Pay the application fees via M-Pesa pay bill number 270988. Your ID is the account number. 2,000 shillings is the charge for a postgraduate. You can also deposit in the bank accounts provided on the website. Then email all the above to apply@mku.ac.ke.